Hi, everybody in MLS Listings. It's Michelle Ronco and Tom Durezzo, and we're back with our favorite partner economist, Dr. Elliot Eisenberg, for a summer check-in. I mean, a lot has happened, so we thought we'd get a few minutes with you. We're thankful you're here to answer some questions that were left over from the last event in June, and also some new things that have come up since we last spoke. So we're glad to have you. Hope all is well.
It's a pleasure to be here. Thank you.
It has been a busy summer, so we're looking forward to getting your thoughts on what's unfolded or is it unfolding.
It is true. Elliot, usually August is where we start to kind of, everybody takes a break and goes on vacation, but I know there's a lot of questions about the real estate market and what's going to happen and just what are some of your thoughts. So let's start off with kind of just a general question, because we saw you 2 months ago, right? So early June, and we were talking about interest rates and market declines and seasonality and all that really important, those important factors going into the summertime. But we've seen prices decline pretty significantly. We've seen some sale to list price ratio declines across counties. And so while not all cities and not all counties are declining in price each month, what are your thoughts on, the seasonal change? Is this more than seasonal, or is this going to be like a persistent change that we should expect to see throughout the end of the year?
I mean, things have certainly calmed down. There's no question about it. And a lot of this happened pretty fast, and it's because of interest rates. This is important to remember. The Fed is trying to slow the economy down. The first sector to experience a slowdown is housing. The data on housing has gotten consistently worse over the last 3, 4, 5 months. For the home builders, I think data came out yesterday. It was 6 months in a row. The housing index they put out is down, and now it's negative territory. Housing is in the crosshairs of the Fed. The fact that housing is slowing down this is not a flaw. This is a design feature going on here right now. So the fact that the housing market's slowing is to be expected. Interest rates have largely peaked, at 5 3/4, 5 7/8, whatever it was a few months ago. I'd be shocked if they get any higher than this now. So that's good news. But the housing market may well weaken a little more. Sales activity may well decline a little more, although we've come down nationally almost as much as we're going to come down. It's come from the low sixes to the low fives. Maybe it falls to the upper fours, but that's about it. Price appreciation this month already is now nationally about zero real price appreciation. So it's come down considerably. I would expect to see average price appreciation nominally continue to fall a little bit, but we're largely done. There's still some more price declines because inventory is rising. This is not a seasonal or cyclical thing. This is an interest rate thing. This is the Fed deliberately engineering a slowdown. And then rates will come down. When they bottom out, they'll stop raising. The stock market will rise. Rates will come down. We'll all be happy. Things will turn around.
We'll all be happy. And that was what I was going to ask is if the interest rates did come down, or as they do come down, or, whatever happens in the future, does that lure buyers back out? Do you really think that that's one of the bigger issues? Or do you think buyers, now that there's some price decrease, will wait, to try to, just like sellers try to hit the top, right? You think buyers will try to hit the bottom?
Yeah, there's certainly some element. It's a question I'm asked all the time, but timing the market's particularly hard, and your life is put on hold while you wait. So my general advice to almost everybody, not from an economic standpoint, but from a life perspective, is get on with the show, sell your house, buy your house, move, do whatever it is you want to do. If you're buying and selling within a short period of time, it doesn't really matter what happens. As long as they both go up, they both go down, so what? It doesn't really matter. For example, you own a house in, I'm making this up, Prague, and you want to buy a house in Seattle, and the markets happen to be nearly identical. Okay, they're not, but suppose they are. Who cares if the price goes up in Seattle? The price also went up where you were before in the other city, in my example, Prague. But who cares? Just get on with it. Timing the market's not possible. You never know what's going to happen. I can give you 5 stories what will happen, right? I think one company came out and said Hartford, Connecticut will be the city that experiences the biggest price increase going forward. I'm sure that's bad advice. I'm sure it's totally wrong. It just is.
I thought you were going to.
So Elliot, interest rates have gone up, which makes it a little bit harder for buyers to buy. Yep. But we've also been hearing that, it's been a seller's market for years and years. when does it switch to being a buyer's market? And is it becoming a buyer's market?
It certainly is. There's no question. If you look at all the data on second home purchases, they've come way down. Number of homes that have had multiple offers coming down. Number of homes that had bidding wars over them coming down. Home price appreciation month to month has come down from 2% a month 4 or 5 months ago. So now something like 2 or 0.3%, 3 or 4 months later, because inventory is going up. So every single indicator is showing a softening market. And the more it softens, the better it is for buyers, the worse it is for sellers. When the house across the street from yours is selling at a list price of $20,000 below your list price, you'd better lower your list price. So it's really important to keep this in mind, but it's a continuum. At one end, it's a super buyer's market. Here is a super seller's market where it was until recently. And now it's still moving in this direction, but there's still not enough inventory out there. So it's still advantage to the seller, certainly, but much less so than before.
That's really important, because we talked to a lot of people about how buyers, were very fatigued and started sitting things out just because writing offers and never getting a home, was not something that people just don't want to do that forever, So we heard anecdotally, Elliot, that people were doing that a lot. The question is, inventory is usually rising in the Bay Area about this time of year, right? And so it's not necessarily unusual that inventory is rising. What you're saying, though, is that all of that supply, we kept saying it's supply and demand. There's just not enough supply and a ton of demand. Are we saying that all of that demand went away because of the interest rates? Because inventory is rising, but it's not rising to a point that we've even seen 2 or 3 years ago. It's still relatively low.
It is. The thing to look at in inventory is to compare year over year inventory. Because as you correctly point out, the first 6 months of the year, almost always, it rises and then it falls, and it rises and it falls. And you have this sawtooth pattern. So the month over month, second half of the year is meaningless. But nationally, and most other places I've looked at, Denver, for example, Indianapolis, Tampa, and on, for you, inventory month over month in the summer months, July, was already starting to rise, June in many cases already. That's a meaningful story, and that's an interest rate driven phenomenon.
Interesting. Elliot, when the Fed kind of comes out and says, hey, we want to have a slowdown because it's purposeful, but you see, sale to list price ratios drop 18% in 3 months, or median prices drop 20% in 3 months. Was that the intended goal? Or they really slammed the brakes, or was it like trying to come in for a soft landing, or is this really what was they hoped would happen?
Okay, that's a really good question. And interest rate sensitive sectors of the economy, like automobile manufacturing, for example, right? So, okay, in the old days, if you lived in Russia, you bought a Lada. You probably didn't put that on financing because the Soviet Union didn't have financing. But if you're in, the Czech Republic and you buy a Skoda car, you finance it. You buy a Ford, you finance it. So those sectors get hit hardest. Automobile, home building is a wildly sensitive interest sector, and the home buying of new and existing homes is super sensitive. So they're going to get hit first. So they may well go in, and I think the home building sector, not the home selling, not realtors, but builders, are already in a recession. They've entered a home building recession for sure. Now, they're not big enough single-handedly to drive the economy into recession, right? But if you get autos, which may or may not happen because there aren't enough, but commercial construction and investment in capital expenditures together, okay, now you get a recession. So housing could get really badly hit, conceivably, and there not be a recession. I don't think this will happen. I'd be shocked. I think we will have a recession, but it's possible. But either way, housing gets hammered. I think that's the point. It's the more interest rate sensitive sector you're in, the more quickly you're going to get hit. So the least sensitive ones, like buying a pair of socks, right? They're not going to get hit. So it's how many of these interest rate sensitive sectors have to get hit before the Fed goes, oh, I think we've had enough. We can start lowering rates, and then they improve. Housing, they're category number 1 on the hit list here. Unfortunately, the good thing is when rates start to come down, housing gets happy quicker.
So new home starts have fallen off,
right,
is one of the outcomes here.
Right, and there are a number of interesting reasons here, but one of the most interesting, important ones is the number of homes being built is ridiculously high. Not because the builders are building so many homes. They're building a reasonable number of homes. It's coming down quite quickly, as I mentioned. But the problem is they can't finish the homes that they're building because they can't get a garage door, they can't get a window, whatever it is, right? So they've got so many of these homes, 300,000 more than under pre-COVID conditions, which was a normal situation. They want to get rid of these homes as fast as they humanly can. They're not interested in building more homes. The good news is there's still a lot more homes coming on the market. The bad news is, well, there are a lot more homes coming on the market. But because of that, iBuyers that are out there, investment buyers that are out there, all these things make the price discovery process, I think, much quicker than was the case 12, 13, 14 years ago. If investors go, I'm out. If iBuyers say, I'm done. If home builders say, goodbye. Whoa, that's a lot of movement in the market much more quickly than we experienced 13 years ago because the iBuyers and the investors weren't there. Now,
that's really interesting. Elliot, does a price, reduction in prices and the more availability of homes accelerate iBuying and the corporations that are coming in and buying residential properties for rent? Does that accelerate in these conditions, or does it kind of stay the same?
It seems not so much. It seems that they're pulling back because they don't want to buy a house today for X and sell it tomorrow for X minus $100,000 and look stupid and have to report quarterly earnings to their shareholder company, the headquarters somewhere. So there's reluctance. So they're pulling back. They'll come back for sure, but no one wants, as they say in Wall Street lingo, to catch a falling knife. And that's the perception right now. Now, individual buyers have a number of other reasons to buy a house beyond the purely financial. It's, well, we just had twins, for example, right? A boy and a girl, for example, right? And we need a place to raise the kids, so we got to buy a house.
That's really interesting. I know a lot of people were concerned about, the corporations coming in and then buying up properties and then renting them. And so that's a really interesting concept. I mean, rates on rentals are also increasing. I mean, as long as we're on the subject. And so does that push people into home ownership? I mean, it seems like a great time to, make the leap if you could.
Well said. I think there's a couple of things going on. If we go back to 2008, 9, I want to repeat, this is not a repeat of 8, 9. It's not happening here. It's a worldly different. And one of the differences is there's a shortage of new homes, existing homes to purchase. Inventories are much lower than they were pre-COVID still, right? We were building homes for flippers, 13 years ago. Now there aren't enough houses out there, and rents continue to rise. I suspect that the rent increases will start to slow down, or already are probably slowing down because home price appreciation is slowing down. Now, rental prices follow home prices, so there's a lagging effect going on, but they will come down. But if you wanted to ditch your home 13 years ago, you could do it and rent an apartment for next to nothing because there were too many of them too. Now you have a shortage of both. So if you leave your house, you're not going to get a reprieve by having a lower rental payment because they're going up. So again, this makes this market very different. So they're both in reasonably good shape. Yeah, price appreciation comes down. We may well end up with price appreciation, nominal price appreciation. So ignoring inflation, just forget about inflation, the price the house sells at, falling down to 2 or 3 or 1%. That was zero. That would not shock me. In some cities, it's going up, in some cities, it's going down, but overall, probably going nowhere.
Yeah.
So, you'd mentioned, and again, this is not 2009. This is not the bottom falling out. However, I've been reading a lot of stories about transactions falling through, and more transactions falling through. Is that actually because buyers are backing out, or is it because it's more stringent and they're not qualifying? But I read this all the time that TFTs are on the rise.
Right. It's not so much stringency. I mean, Dodd-Frank's been around for a while. We know what the scores you need and income and all that kind of stuff. And if you look at the FICO scores of the buyers who are buying homes, FICO scores remain really iron strong. They're very high. They were, wildly higher than they were 13 years ago, but objectively very high. What's going on is buyers get scared. There's just fear on one hand. Oh my gosh, rates are higher. I may lose my job. Maybe there'll be a recession. Let's not buy a house. The other thing is a lot of people who had planned to buy a house 8, 9, 10 months ago, a year ago, and put a down payment on the house now have to afford the higher construction loan. and the construction loans at 5.5, not what they thought might be 3.5. And suddenly they go, whoa, I'm out. So you got a couple, it's fear and higher rates together doing a job on the deals falling apart. That's another indicator of a softening, weakening market. You look at all these variables across the board, they're all weakening. Yeah, some more than others, but yeah, good point.
Okay.
It's really interesting because we have national news, and oftentimes when we speak to our agents and brokers, we say, be careful, because the Bay Area is really kind of in a unique position in terms of wealth and how we fared in the pandemic and different things of that nature. So when people say, hey, I'm a little nervous about an upcoming recession, maybe it's not time to buy a house, do you believe that the Bay Area will be less affected by a potential, recession moving forward? Is it kind of like what you said during the pandemic, where there's still a lot of people making a lot of money and therefore they may want to go out and buy a new house or move up, or are we kind of like the rest of the country, just kind of waiting to see what's going to happen with employment, or are people going to lose jobs, or people going to have change of salaries, or do you think the Bay Area is going to be a little insulated to that?
I think the Bay Area gets a little bit better treatment. You're not a manufacturing base here. I mean, you manufacture software, but that's a pretty different thing than manufacturing hardware. So you have a recession. It's the upper Midwest and the Midwest that tends to get hit. Autos tend to get hit. They may not this time because there aren't enough cars in the first place out there. So there's no, even if demand falls, there still aren't enough cars because we're 3 or 4 million cars short. But it's manufacturing that tends to take it on the chin. And if you look at some of the data on manufacturing, you could make the case that manufacturing is already in a recession in some parts of the country. So I think Silicon Valley generally does better. But look, San Francisco's certainly taken. A lot of people aren't going to work in San Francisco. People are, in fact, moving away and so on. You're not totally immune. If you look at the stock market, okay, it's come back. But IPOs, they've pretty much stopped. If you look at SPACs, blank check companies that buy that public new companies can be made public out of, they've completely stopped. Crypto's gotten significantly weaker. So firms are going to pull back on some software purchases inevitably. So, the laundry list of firms will suffer to some extent, but no. It's not like we're going to stop buying things on, okay, Amazon's a bad example. They're headquartered in Seattle, but you get the idea, right? Facebook, yeah, we're going to be on Facebook, Instagram, Twitter, whatever it is.
Because I have heard some brokers saying, if you bought a home and something really did happen with your job, or if your circumstances changed pretty significantly, you could sell the house, right? And your loss would be pretty minimal. I mean, depending on when and how long you've had it, and there's tax implications and things of that nature. But in general, no one is coming out like 2008 where we're fire sailing and there's 4 on the block, and that kind of a thing. And so I've heard that and thought, wow, that's an interesting way, because if you don't lose your job, this is, with prices down, could be a wonderful opportunity.
This is a great point, right? I mean, you think about unemployment. Unemployment's a catastrophe if you lose your job and you can't find another one quickly. Inflation, for example, yeah, it's inconvenient. We all have to pay more for airplane tickets or baseball tickets or whatever it is, or you want to go see some team in the Czech league or something, or the German league or whatever. You pay a little more for your ticket, but it doesn't really matter. Home price declines are a bonus. Maybe you want to buy a second home. I mean, this is objectively a great time to start looking. If you have cash, dynamite time to buy a house right now, right? So there are ways you can take advantage. And if you're a lender, if you're a realtor, you want to find products that help your buyers in, maybe a 2-1 buy down. So they have 2 years kind of to get the rate's artificially low for 2% the first year, 1% the second year, and the third year it hits normal. But by then, a lot of things have changed.
So Elliot, what can sellers do? One of the things that has in the Bay Area that's really gotten a lot of press is accessory dwelling units, the ADUs, and so is that something that sellers should be considering? At least as a possibility, as that a buyer could potentially build one if they wanted to, or the seller could potentially build one to add value to the property. What are your thoughts on ADUs?
I think the ADU idea is great. It's not a silver bullet. There's no silver bullet out there. But if you can expand the concentration of people on a piece of property and add an in-law apartment, an official in-law apartment, or a carriage house in the garage or whatever. That's great. It's great for the population, more housing available, lower prices. I mean, they'll go up more slowly. They're not going to come down, but this is a good idea. And in terms of selling your property, if I were a seller in a highly contested market where there's a lot of other competitive units out there, I might go to the city or architect anyways and say, hey, can I buy a plan off of you, sort of off the shelf? I don't want to invest $25,000 on a customized ADU, but you have one like that kind of fits for what I got, and can you customize it for $5 or whatever it costs? And say, hey, to a seller, hey, as a seller, you can say, hey, if you buy my unit, here's essentially a pre-approved off-the-shelf ADU that you can build. It's going to cost you, 180,000, 240, whatever. And right now the current rent's going to get you whatever it is, $3,800, $4,200 a month. That's a cool thing. That's an appealing thought to a lot of potential buyers. Yeah, it'll help me pay the mortgage, more income, cash flow, whatever. It's an unambiguously positive thing because someone's going to go, yeah, that's what I want to do. I'll build it myself, sweat equity, whatever it is. But you've already got something in the bag. It's like making your house look pretty. Clean it up and get rid of the crap in the closet and declutter the place. This is beyond decluttering. This is adding, real value here.
Yeah, adding footprint. Yeah, actually, we do have a tool for our subscribers from a company called Symbiom that allows them to put in a property address, and they can see whether ADUs are allowed and where they would fit, and even look at plans. So good. I'm glad that's something of value and helpful.
Oh yeah.
So
absolutely. Yeah. It's just that some people want to buy a duplex and rent the downstairs and live in the upstairs, or vice versa. This is kind of on that continuum. If that's the duplex and that's a single fam unattached house, having the plans for the ADU that would get approved is somewhere in the middle or something.
Yeah.
Yes.
Yeah.
Right on.
It's one of the questions we had the most of that we didn't get to in June. Elliot was on ADUs, and I got a lot of feedback from people that was like, talk about ADUs, because not only can it be additional money each month, but also culturally we have a lot of folks where you take your parents, right? So you live multi-generationally, or as we're getting ready to take care of our elderly parents, in the Bay Area, that becomes a real issue in terms of what do we do now? And so instead of being forced to sell, so the ADU I think got a lot of questions because people ask just generally if you can do it. They tell you fix up kitchens and bathrooms, right? That's what gets the most returns. But we're saying then, ADUs is what you're saying is just like the kitchen, the bathroom, and the ADU. Always a good idea?
Pretty much. In a market that's so inventory starved like yours, it's hard to imagine a rental property that's not appealing. The issue that I think that people who build ADUs, the homeowner who's building the ADU, not physically the person, the GC you're hiring, is, what's the economics of it? What size do you want to build? How fancy do you want to make it? How many square feet of your basement do you want to devote? All, half, none, some, a lot? I don't know. But it's got to make ROI and ROE, returns got to look, the internal rate of returns got to be right. But yeah, it's very hard unless you're making a bad business decision, like making it, building a 3,000 square foot ADU seems ill-advised if your basement can withstand it. That's a bit much, but use common business sense. But yeah, it's hard to imagine this not working out well in a region that's so constricted.
Yeah, with no likely change, right? Because we just have running out of space. But yeah, inventory is rising. I mean, what do you say? This is, interesting because for the last 3 years or so, we've been talking about how to talk to buyers, right? How to explain markets and how to explain that, this is what happens. And there's a lot of value and very limited inventory. And it's just what kind of the cost of doing business and, the expectations. We saw some cities over 120% of ask, for a while there, and, just some really tough things to take. And now I'm asking you the question, how do you talk to your sellers about the fact that they may have missed the peak? I mean, it looks like it. We won't know till the end of the year, but we saw some really high prices. How do you talk to your sellers about the fact that they didn't get what the neighbor got? but there's still a lot of value. Or what is it that you could add from kind of your perspective to talk to sellers about who maybe were getting ready to and are now, getting cold feet?
You just pretty much said it. Look, things change. You've got to adapt. And I think the realtors got to show or begin to show prices that they peaked, or the price appreciation's much slower, or there's a lot more units on the market than there were. And now it's a more competitive market. And if you want to wait 6 months or a year to sell your house, keep it at a high price. But if you're getting no mojo and no shows and no showings and no interest and no bites, clearly you're overpriced. And the realtor should be saying, we have to watch that, how much activity is our house generating? That's the important thing to keep in mind. In the old days, it was just, put a sign out there, 100 people camping outside to make an offer. Now you're going to have to fight tooth and nail. And part of that is making the house pretty, having the right price, being flexible if an offer shows up, and remembering that you probably bought this house 5, 6, 7, 8, 9 years ago, and you're looking at a nice capital gain, a nice appreciation, and bulls make money and bears make money and pigs get slaughtered. Right. So just get on with your life and accept what it is. And even if the price, even if it's flat compared to 3 months ago, so what? Or down 3%, so what? In the grand scheme of things, look, I'm losing my hair and I'm managing to live quite successfully. Thank you very much. This isn't a disaster. No one's losing a limb. But make sure to check all the bases, declutter your house, do everything in your power to make your home appealing. That's critically important now. And trust the realtor to hopefully give you good advice and accept it.
Yeah, no, it's definitely, I heard someone say this morning, one of our brokers, a really seasoned, say, this is where the hard work comes in, because, this is when homes are not, selling themselves. I mean, you really have to go in and price things appropriately and get the right eyes on there. And so, but it was also like, if you thought that, the last few years was an easy market or a good market, it wasn't for buyers. So this is more even. And there may be now more influx of buyers coming in, fresh buyers that are saying, okay, I'll re-enter the market. And so for agents, it could be just a little bit more balanced in terms of who you're trying to find. You were trying to find the sellers before, and maybe now you're working with more buyers.
Right. And many buyers, as each realtor's got stories. They know of a buyer or a family or a household or a husband and wife with a kid, and they just gave up. They just got depressed. They lost out on so many bids. Finally, now they can say, hey guys, now's your time. Inventory's tripled since then. Let's get the show on the road. And you can make a big down payment or whatever. There's always winners and losers here.
Yeah, in every transaction.
That's really important to point out.
Yeah, Elliot. Oh, sorry, Tom. Go ahead, Tom.
Oh well, actually, I wanted to make sure I got the right takeaways from today. So so we believe interest rates have peaked.
Yes.
We see inventories growing, and so we're seeing it convert from a seller's market to a balanced or even buyer's market.
In that direction, certainly.
Yeah. And on the recession front, unlikely at this point, or still up in the air as to whether we're going to go into a recession?
I think we're going to go into a recession. I think the stock market's unrealistically optimistic that the Fed's going to start cutting rates early next year. No, if the economy stays as good as it is right now, the Fed will keep raising rates. That's the problem. And the more they raise, the higher the chances of recession. The Fed's telling us, look, we're going to keep raising rates. They're having a lot of people say, look, we're going to keep. They even had one of the real doves, one of the people who doesn't like to raise rates, the president of the Minneapolis Fed, a guy named Neil Kashkari, come out and say, yeah, we're going to keep raising rates. And the stock market really is not paying attention to this. I think the chances of the Fed cutting rates quickly and the economy barely being bruised from the rate hikes that we've already experienced is really remote. Not zero, but really remote. China's slowing. Europe's probably entering recession. Canada's weak. The Brits are weak. Almost every central bank in the world is raising rates. We're going to have a recession.
But that would tend to ease mortgage rates. Is that true?
Absolutely. Right. So this is a temporary phenomenon. And when we get out, we'll be even more housing short because over the next, starting a few months ago through another 8-9 months, home builders will be building less homes than they would otherwise have. So the housing shortage of 4 million homes is now closer to 5 million homes or whatever it is. So the outlook for housing over the next 5-10 years following this recession, when there's less being built, hey, it's even better. Short-term phenomena. I mean, serious, meaningful, don't ignore it, but the long-term prospects are at least as good as they were, if not better.
Wow. So really, if buyers should get out there and buy now while they have the power and they can, because what I just heard you say is it's going to swing back to the sellers. At
Rates come down. Rates come down a little bit. They come down 50 basis points, 60 basis points. And there's no more houses than there were before, and now there's some more affordable buyers who can get in. Yeah, housing continues to be an undersupplied product. That's the fundamental problem that we face.
Yeah, I think that's an interesting concept. Inventory is rising. It's still woefully low, though, right?
Right. Now, if it keeps going up at the rate it is, in 12 months or whatever it is, we'll be back at pre-COVID levels. Okay, that's a pretty balanced market pre-COVID. That was not nationally. Where you were, it was still ridiculously tight. And remember, also the lack of IPOs and SPACs and so on, and crypto is certainly weakening the growth of the millionaire population in the Valley.
Wow. Well, Tom did a great job of summarizing. I think those points are really important. And we're going to talk to you again in the fall, Elliot. So we'll see you in a couple of months. Until then, you told us to keep an eye on inventory, just kind of what can people do in the interim, right? So in June, you said, hey, keep your eye on inventory. And then I pressed you for one more. And you said sale to list price. Watch those, which have come down pretty dramatically since we last spoke. At this point, what would you encourage people to see? We see a lot of price reductions. We're seeing sale to list price ratio come down and inventory rising. Anything else that you would advise our folks to keep an eye on?
On the general side, I'd expand the population of things to look at, and look at unemployment. If it stays very low, the Fed will have a very hard time getting inflation under control, because wage inflation will continue to grind, 4.5%, 5, now it's 5.5%. The Fed's target's 2. If wage growth is going at 5, that's a big difference. There's some productivity growth in there that can bring it down, but we haven't had that lately for other reasons. So if we want to see unemployment begin to tick up. And we can argue how much we want it to tick up, but it's got to tick up. There's no way you can have even a soft landing without unemployment rising. It will rise. The question is how much and how quickly. But watch it. This will give you inklings of what the Fed may do in terms of how many more hikes or when they begin to slow down. But if unemployment doesn't budge, lots more hikes in the cycle.
Yikes. Well, this is really great advice, Elliot. We are out on the road. We talk to our subscribers all the time about what's happening in the market. I follow your advice and look, year over year. We try to give a longer term look. We try to remind people of seasonal change, so it's not all just unusual. Maybe the degree is a little bit higher. And we're keeping our eye on a lot of different things that are important to our agents and brokers out there. But we listen to you and we do what you say. You said inventory. I started throwing inventory slides in. Tom and I are always just trying to get out the right information for our folks so that they can be as knowledgeable as possible. Because I know everybody's talking about the real estate market right now, and it's a great time to get out there and have conversations with people who are, making plans. So this is a really great check-in. I enjoy having you.
Hey, so if people want to hear from you, Elliot, every single day, isn't there a special way that they can do that?
Why, yes, there is. And thank you for asking and prompting me. I'm not sure they want to hear more bad news about recession likelihood. And someone called me up recently for an interview and said, I'm happy to have you on the show. And I say, is it really? But that having been said, here's a website. This is not a website. How to sign up for my daily 70 words of economics. No graphs, no ads, no charts, no links, no photos. The easiest way is to take your cell phone and text the word bow tie, one word, to the 5-digit number 22828. 22828. 2828, the word bow tie, and then you'll be prompted for an email address. Please type it in correctly, and you'll hear from me every day starting tonight. 70 words, no graphs, no ads, no charts, no links, no photos. Thank you very much, Tom.
Oh, some of us like graphs. I mean, Tom and I love graphs. I mean, that's no, I'm just kidding. But yeah, no, that's a great resource. And I know people tell me afterwards, like I subscribed and it's so entertaining. And I said, oh, he's had a lot of fun. So hopefully people will go to Bowtie, all one word, Bowtie 22828, and be a supporter of Dr. Elliot Eisenberg, our partner economist, someone we lean on certainly for information, to be forward looking, to give us advice and to put things in perspective for us. So thank you so much for joining. And we'll see you guys again in maybe October, early November. So before the end of the year, to get your thoughts on the end of the year and the beginning of next, because that will be really exciting as well.
There's an election going on there as well.
Yeah, so we're going to need you. So stay tuned, Elliot, because we're going to need you. But anyway, great to see you again, Tom. Thanks for everything. Really appreciate it. Hope you guys found this to be helpful, and we'll see you soon.
Thank you, Michelle. Thank you, Tom.
All right. See you.
For current data and market trends by county, be sure to watch our Oculus Market Minute videos located under the Reports and Statistics section in our Pro Support channel.